In this video, I'll share 5 key secrets I've learned throughout my years of experience in becoming profitable in gold trading. I'm offering this valuable knowledge drawn from my extensive experience to you at no cost in one single video. Let's begin. So let's start with this. You might have a specific strategy that you're using as of now, and it's really working well with currency pairs. So let's say you're trading the euro dollar, the pound dollar, any FX pairs, and it's working perfectly. You are making money. Now you go and make money here. You try to use the same setup and the same strategy in gold, but somehow it's not working. That's because gold tends to move in a kind of a different way, and it follows specific things that I've learned throughout the years. So at least for me, it moves different than the currency pairs. Sometimes it respects trend lines while the currency pairs do not. Sometimes it does not while the currency pairs do. So it's a little bit different and tricky. And you might be confused that, oh, is my strategy not working at all? Or is it only that it does not work on gold? That's why in this video, I'll give you 5 key secrets that you can actually apply even to your strategy to make it work on gold. Also, those might be 5 ways on trading gold. So any of those ways can be taken as a strategy. So starting with secret 1, gold respect order blocks and breaker blocks more than any other PD arrays. You'll realize that if you're trying to trade, fair value gaps, not in the, appropriate condition and scenario, it's not gonna work. Usually, because of the volatility of gold, it's going to go to the extreme points, either to the high, the low, or the order blocks. And a lot of the time, it's gonna go to the order blocks. Or sometimes it goes to supply and demand. So it's not gonna respect half of the range, which usually some fair value gaps are. Most of the times in reality is going to go to the order block, so disrespecting the fair value gaps, unless we have a fair value gap that is also overlapping with an order block, and we're going to take an example on that. But in general, gold actually respect order blocks and breaker blocks more than the other PD arrays. That does not mean that fair value gaps is not respected. It is respected, and I'll show you when. So in this diagram here, this is how golds actually behave. What's going to happen is that, we're going to be creating an order block here, going lower. Price will tend to disrespect any fair value gaps here. So you see all those fair value gaps in the range. We might get some reaction, like small ones here. You could get some good reward to risk using a lower time for confirmation. What's going to happen after is we're going to the order block, disrespecting everything here. And then creating another order block and creating some fair value gaps here and some other PD arrays, disrespecting all of those, respecting the breaker block and then the order block ultimately. Then we go again lower. Now in sometimes where we have a big range like this, from this high to the low here, that's a big range. It's not going to be optimal for gold to go all the way up here in order to go lower again. If it wants to go lower and the range is too big, it's going to look for the fair value gaps. So it's going to come to this fair value gap here, react of it. This is a time where fair value gaps might work. In other times, it's going to work if you have a fair value gap here that is also aligning with the order block, and we're going to take an example on that. Now what's going to happen here is reaction, order block is going to disrespect anything in here disrespected, go into the order block, again a creation of an order block here. That's what we respect. An order block here, that's what we respect. You see any fair value gap here is disrespected. We're going up again. Now, because this range is also too big here, and you see, sometime we're going to react off a fair value gap. So we have something like this, where we have order block here and a fair value gap here. Price could react from the fair value gap, go lower, but the right and the big move is going to be off the order block. So you might actually make some money off a fair value gap. But eventually, price might go to the order block and then give the real reaction and the real move of the order block. You see here, again, reacting of the fair value gap and then an order block. So it's usually going to react off order blocks. That's what you need to focus more on if you want to make money in the long term. Now, also we have breaker blocks, and that's what we're going to be also covering on one of the next secrets, because the same as gold respect order blocks, it also respect the market structure and breaker blocks, and that's one of the secrets I'm gonna give you later. Now the fair value gaps that are higher probability is fair value gaps that are going to be somewhere in here. You see this order block? The fair value gap that is after the order block, that's going to be also a high probability one. So you could look for that fair value gap to be filled as well as a touch into the order block. That's going to be a good one. Same thing here. If we have a fair value gap that is here, that's going to be the best one. Same thing here. The fair value gap that is below the order block in a bearish scenario and the opposite in a bullish scenario. Now, if we look at gold in the 4-hour time frame, what we can see is an order block that is here. If you look at this order block here, this order block caused almost all of those fair value gaps. Either this one, I mean, there is also an order block here, but there is one that is higher. We have this one here. So this order block here was respected once, twice, 3 times, 4 times. And any fair value gap, even though this fair value gap, you see, we come to this fair value gap and then we also went lower. This fair value gap after is disrespected. Why? Because we have this order block now. And a lot of the time we get a reaction of the fair value gap, then the real reaction of the order block. Now, same thing, this order block here caused this fair value gap to be disrespected. We had just a small reaction of the fair value gap. And then after that, we come to the order block. And this is something that we're going to be talking about also later, about refining. And you see, we get a reaction of that order block. Same thing here. If we look at this order block here to the upside, you see, after getting the xauusd here, the change state delivery, it activates this as an order block and then getting a reaction of it immediately to the upside. And then another reaction again to the upside. Same thing here. Whenever we have, I mean, a lot of people have a wrong idea about an order block. An order block is the change in state delivery, as I always explain. You see here, what was happening is we're going lower, sweeping liquidity, and then we have that higher time frame xauusd and lower time frame market structure shift. If we zoom in here into those two candles, we're going to see something that looks like this: going up, sweeping liquidity, and then breaking the high. That is what? That is a market structure shift in the lower time frame as well as a xauusd in the higher time frame. Now, immediately after this candle closing above this candle, we have this candle here as an order block. And what happened after is price coming to this order block and then reacting higher. Same thing here. And a lot of the time you will see that. For example, this one, we have this candle where we sweep liquidity and then we get the xauusd here and then we get a respect of that order block. So you see, we respect order blocks more than anything. And in this case, this order block is also a high probability, makes this fair value gap being respected. Why? Because it's overlapping also with an order block. So we have an order block and a fair value gap that are next to each other and close to each other, becomes a high probability. Now you're going to notice that it's always the order block that holds price higher and lower. You see here, this last bearish candle closed above activates this as an order block. And we have this fair value gap here. Actually, those fair value gaps here, if we notice, what's happened is reaction, small one, but then eventually disrespected. Where did we react from? Eventually from the order block that is right here. You see this order block? That is the zone that where we're gonna get the real reaction of. You see here, reaction going higher. And same thing here, maybe in the future, if gold decided to go lower, we might not see those fair value gaps holding, but the order block that we have. Maybe in the future, we have this order block here. We might not see gold reacting of this fair value gap, but from the order block here. And the small fair value gap, that is what? Aligning with the order block. So your priority when it comes to trading gold should be, first of all, order blocks, then breaker blocks, and we're going to be covering this later. And then finally, fair value gaps. Fair value gaps should not be your first priority. Even though for me, at least, I use fair value gaps in all the currency pairs and it is my favorite thing. And I do also trade gold on my own way using fair value gaps, but I do suggest for beginners to stick with order blocks because it's going to refine your entry more. Secret number 2, gold follows the market structure more than any other pairs I know. And when I talk about market structure, I'm talking about the trend. It actually shows us what the trend is. Now, market structure can be full of traps, but in gold, it has less traps, especially for the market structure. Now, before getting into the secret, if you are not familiar on how to identify and map your market structure, I don't have a full video about this. It's called Market Structure Masterclass, and then you can just look it up on YouTube or I'll leave it in the description. Now, how we look at gold is by identifying the market structure. Now, usually in few simple words, a strong high and strong low needs to be identified, A strong high needs to either sweep liquidity or mitigate a POI and then break a structure. A strong low is also the same thing. We need to sweep liquidity or mitigate a POI and then break a structure. Now, what is a strong high and strong low? It's a high or low that most likely won't be taken. And if it's taken, then that means we have the shift in the market structure. Now, if you see this diagram here, this is how gold actually moves. It breaks structure after mitigating a POI, it moves in that direction. If you try to go against and maybe look for a liquidity sweep here, it's like committing a suicide. You are being against a trend. And what asset? Gold. You cannot be against a trend in gold. Otherwise, you will be again like committing suicide. So it's going to go lower and keep going lower until when? We're going to see when, somewhere in here. But you see, respects the order flow always and then break a structure. If you can see 1 and 2 break structures to the downside, that can confirm the trend for you. So as long as I see 2 break structures and 2 major mitigations, then I know the trend is to the lower side and I'm not looking to trade reversals. I'm not trying to be against the trend. I'm looking for mitigations and then continuation on the same trend. You see here again, mitigation, continuation of the same trend until, and this is the time when maybe I'll switch the bias and the trend might change. It's when we have a break of a strong high and a clear market structure. See this high here? It mitigates this breaker block here and this old low and then break structure to the downside. But eventually, maybe we reacted of another POI that is stronger and in a higher time frame, and then we break the last strong high in this case. That means now that we are bullish. At this point, we switch from bearish, which is this whole move here, to bullish, and we're starting to go up. Now, this might be temporary and it might be a trap, or it can be a real market structure shift. And the moment you see this, a market structure shift, you want to confirm it with another one, but you could trade it immediately if you want. That's also possible. So you look for an order block here or a breaker block or a fair value gap, and then you trade with the new trend and the second break. So this is 1, this is 2. The moment you have your second break, that confirms that we have a new trend. Okay, it's more confirmation. So 2 breaker structures on one side, that means we have that bias. 2 breaker structures to the lower side, we are bearish. 2 breaker structures to the upside, you are bullish. If you try to go against the trend, it will be a big problem and you will lose a lot of money, especially in gold. You cannot go against the trend. I mean, if you stick to this, stop your emotions and stop your desire to take just a lot of trades instead of taking maybe lower but higher quality trades, you'll have a big difference and it's going to have a big impact on your trading. It's just that you want to be with a trend. And a lot of people mention that you want to be with a trend, but they don't realize the mistakes they're doing in order to identify their trend, identify their market structure, the valid one, not just the the traditional way that a lot of people make mistakes with. So make sure to watch my video and stick to the trend in gold. That's a must. Now this is gold on the 15-minute time frame, and we're not gonna be go precise on the structure mapping because it takes some time, especially on the 15-minute time frame. But I just want you to see how simple it can be just by identifying where your last breaker structure is and maybe your last 2 breaker structures. Now, if we look at, if we start from here, from this day, this is Wednesday, we have a breaker structure to the upside, right? On this day, at the start of the Asian, this is where the volumes kicks in. We have a breaker structure to the upside, we go up, we sweep liquidity, and then we break a structure. At this point, since we have 2 breaker structures, I mean, 1 is enough, 2 is more confirmation. We know that we are going up. And then we keep going up, you're all bullish until here. Now, we have this minor breaker structure to the downside. At this point, I might be bearish, but when I see that we are just coming lower to mitigate some order flow here, as well as sweeping this liquidity, I know that we are still bullish. Break in structure here, going up. I'm still bullish in this case. This is all internal too, right? Because we did not break, we're still respecting this order flow here. Then we break structure again. Also another confirmation that we are going higher. What happened after is another break of structure. And I'm not sure here if it was going to continue, but I see this candle closing above. I know it's a break of structure. What happened after is a liquidity sweep and then break of structure again. I'm bullish all the way here. I'm not trying to go against the trend. What happened after is still coming lower. We did not sweep the low, but then breaking structure again. I'm still bullish in this case. You see, we don't go bearish until what? Until we have something like this, where we have a clear market structure. So you see, we're going up, we're coming lower, and then we sweep liquidity, and then we break lower. That's also not enough confirmation to go lower. But when I see that we have another break of structure to the downside, it means that we might have a change in the order flow, because this first one can be just another mitigation or sweep of liquidity to the to go to the upside later. But if I have two break of structures to the downside, that means we are switching the order flow. In this case, I don't see any two break of structures to the downside. It means we are still bullish. Now I can see maybe price coming to somewhere in here and then pushing higher, unless we have something like this. We have sweep, market structure shift, and then maybe another break of structure to the downside. I know that we are to go lower now. So if you go to 15 minutes time frame, anywhere in the price action, identify where your break of structure is, and then we can go from there. That is why you need to follow the order flow and the trend and the market structure on gold, because it's usually a trending asset. So if it wants to go up, it's going to go up, and you cannot just keep shorting all the time, because you see here a lot of people were betting on gold to go lower because it's at all-time high, but then here somewhere in here, but then eventually goes up. Respect the order flow. If you can see here, what is happening is going up, coming lower, going up, coming lower, going up, and then still ranging here until we break to the upside. What happened in the big picture is we go lower and then we go up. So what I'm looking for in the big picture is to come somewhere in here to this previous range and then maybe go up. Unless we have something different than this, then we can change the trading plan. Otherwise, for now, I can see gold maybe retracing, but then going higher. Again, unless I see a market structure shift and maybe two breaker structures to the downside, I can change my idea. Secret number 3. Gold tends to trap traders by sweeping structural liquidity. Now, a lot of people understand the concepts of liquidity, but not everyone understands the structural liquidity. And I did explain this, I don't know, maybe 2 months ago in one of my videos. It's called the gold trading strategy. I explained that you only need 2 types of liquidity: inducement liquidity and structural liquidity. I'll have that video on the description. Now, maybe some people did understand the inducement liquidity, but not a lot of people understand the structural liquidity. And gold, based on my experience, tend to go to those structural liquidity, sweep them, and trap people thinking that it's going to take the extreme high or extreme low, but in reality, it only goes to the structural liquidity. But before that, let me give you a quick introduction and overview about the structural liquidity. But before going to the example, what do you see here? What do you think is going to happen? We have this range here, and then price looks like it's switching from bearish here to bullish, maybe taking this high, then it's going to go lower. That's what a lot of people would see happening. Okay, they're gonna see this high being taken, but what is going to happen is something that most likely does not happen on the other FX pairs. I mean, it happens because it's still a valid liquidity, but usually FX pairs will tend to take those failure swings. Okay, failure swings. We have a high and a lower high. Those are low resistance liquidity condition. But in gold, it's a bit different. We have structural liquidity somewhere in here, and that's what I'm going to be explaining later. And we're going to go over this example on TradingView and show you what happened exactly and why it happened. But before that, we need to identify what a structural liquidity is. Okay, so imagine we have identified a strong low, which is by sweeping liquidity and then breaking structure. That's either a higher time frame CISD or lower time frame market structure shift. It's all the same thing, just depending on what time frame you're using. Now we have identified the strong low. Now the range that we have the strong low to the highest high, this range from here to here, see this one here, there is a structural liquidity that lies in here. Okay. And what is a structural liquidity? It's the first valid pullback in the valid swing. So we have this valid swing here. The first pullback, so you see this one here, that's the strong low. The first pullback that happens after the strong low is the structural liquidity. What you can see is this is the first valid pullback. What's going to happen is price going up, then come lower all the way down, and that proves to you why gold is most of the time goes to the order blocks instead of fair value gaps. Why? Because it also tends to sweep the structural liquidity, which is most of the time extreme to the lower side in this case. So it goes and takes the liquidity from the structural liquidity, the first pullback, and then pushes higher. In the bearish example, it's also the same thing like here. So this is, or let's say we have something like this strong high here. Okay, throw in again, we have the strong high, and then we have a pullback. This is the structural liquidity in the bearish example. This is gold on the 4-hour time frame. The example that we were looking at is this one here, those two failure swings, and then this is where price comes. So what happened is actually price respecting this strong high, which was not taken, and what happened is taking this structural liquidity. So you see how good this structural liquidity is, because in this valid swing from here to the lowest low here, this is the range that we have here, this is the swing. What happened is this is the first pullback that we have in this range. That's where price goes and then goes lower. Now if you realize what was happening here is price coming again to the order block. So that's another retest of the order block, still respecting that order block, and then goes lower. If you look at this again, okay, so let's say we're looking at the same thing here. What happened here is sweeping some liquidity and then going up, and then a pullback to the lower side, then break in structure and market structure shift. What happened here is we have this extreme order block, okay, and you see that it's getting respected. And also, why is that? Because we have in this valid swing, I mean, if we mark this as our strong low, where is the first pullback in this range? From here all the way to up here. That is the first pullback. That is what? A structural liquidity that did not rebalance the first order block. That's why this now is a very high probability liquidity level to be taken. And when a lot of people see price going lower here, they're going to think that is going also to take this low. So a lot of people are trapped here. What happened is just going up aggressively. Now you could see this happening all the time, all the time. You see here, what we have is this level here, where it actually does not take a liquidity level here, I guess, because it's it was almost all-time high. What we had is this order block, and then what happened is price coming to this order block. What happened here is a market structure shift to the lower side, and then this is your first pullback. That is where price comes to, first pullback, taking that into the order block, protecting this high because it's a strong high. So we did not take this strong high, we only take this one. A lot of people will think that we have kind of relative equal highs or failure swings, and price will need to take this one as well as this one. What happened is price only taking the structural liquidity in this case and not this strong high. And you will see this happen a lot of the times. As an example here is, you see how we get a very nice reaction of this first pullback in this swing here. We had a strong high, first pullback, get a very nice reaction of here, and then eventually it was taken, yes, but we get a very nice reaction of here. Same thing here. What happened is the strong low here, and then the first valid pullback is this one. What happened is a sweep of that one into the order block here, and then same thing, we have this low here, first pullback, taking that first pullback again here. Now you could look at this in too many different ways, but you will realize that gold tends to respect those and trap a lot of people who are not familiar with the structural liquidity, and it's a very good thing to take advantage of. So make sure to understand and focus also on the structural liquidity, the same as the inducement liquidity, but I decided to mention this here because not a lot of people are familiar with the structural liquidity. Secret number 4, and in my opinion this is one of the most important concepts, not in only gold trading but in all of the other pairs and trading in general. You know, this rule here makes me a better trader 100%. So feel free to apply this on gold or any other pair, but I find it very effective on gold. That does not mean that it does not work on other currencies. It actually works much even better on indices. So the secret is that gold, closure, and rejection rule. What does that mean? That means body versus a wick. And we're going to cover all that in the next slide. So the rule says, and it applies on any time frame, any time of the day. You want to usually look at it in times of, you know, high volatility, because it's going to confirm the direction. You don't want to look at this in times where there is no volatility or it's ranging. Now, again, any time frame, the rule says we have two conditions, 1 and 2. The first one says, if we have a candle that is, for example, bearish, and then we flip to the upside, or it can be a continuation. It can be a bullish candle and another bullish candle. But the rule says that we have a body closure above or below the previous candle. That means a continuation. We closed above this previous candle. That means we're continuing to the upside on the next candle. And we are going upside as long as we are closing above the previous candle, and we're not in a key level. We are still looking for continuation. We are still looking for a trend to the upside in this case. In another scenario, and that is scenario number 2, is we have, let's say, after a few candles going to the upside where we have consecutive closures to the upside, we have a big wick, and then the next candle fails to close above. Maybe it swept the high, and maybe it did not. So maybe it was just inside of the previous candle range, and we could actually apply this rule. So if we have the body of this candle is inside of the range of the previous candle and it was not able to go above it, actually close above it, we might have a potential reversal. So a rejection equals reversal. And having those two scenarios in front of you in any pair, any assets, that's going to have the most impact on your trading, period. I'm really confident about this because I do apply it all the time. And in my opinion, it's one of the most important rules of trading. Now, another thing to mention also is based on CCT, or the candle continuity theory. That's a video that I've introduced before on my channel. You could look at it. You could look it up on YouTube. I'll also leave it on the description. It says that after a candle closure, a new candle will follow the previous candle color, and that is the bias based on the name candle continuity theory. So if we have a lot of bullish candles and then at some point we get a bearish candle, the probability of next candle is to be bearish more than bullish. You see here, this candle is bearish. I'm looking for bearishness more than bullishness. Okay, unless we get a bullish candle, then the bullish becomes higher probability, and then higher probability until we have a bearish candle. Then the higher probability of next candle is to be bearish more than bullish. So we always follow the next candle color, unless what we have some scenarios where we actually don't trust the CCT, and that's all I mentioned on the video. It's really something you've never heard about, so make sure to also watch that video. So let's go to trading view, look at some examples, and let's see how we can take advantage of this powerful concept and very easy concept. Now you could look at any time frame here. Any time frame will do the same thing. Just remember that there's going to be more volatility and more noise on the lower time frames. If we can start from anywhere, so let's say starting from let's say this level here or this point, what we can see is that we are bullish and then we fail to just place above and close above. What happened is we're expecting this candle to be bearish unless we reach maybe a key level. Remember that we cannot blindly rely on this. We need some other confluences. But what happened here is going up, closing above the previous candle. That means we are continuing up. That's what happened here, continuing up. I'm looking at the next candle to also continue up. But what happened is what? We failed to close above. That means I know that we're going lower. And what happened here is going lower. Then we close below, means we're continuing lower. In this case, this is the low of the candle range here. We were not able to displace below it. And same thing here. We only swept the previous candle low. So that means we're not able to displace lower. That means that we have some weakness in the market at this point and at this level. That means there is a potential reversal. Why? Because we had a rejection. rejection equals reversal. And what happened after is closing above and then closing above. I'm looking for continuation, closing above, looking for continuation until what? We have the same thing, not being able to close above. That means we're going lower. And that's what happened. Closing below, that means we're going lower. We failed to close below and then we flip bullish. That means also based on the CCT or the candle continuity theory is that we are about to push higher. And that's what happened here. That's an inside candle. I would say it's half and half because it did not sweep the previous candle high. Now we had some ranges here. At some point you might want to stop, but it's still working. You see, not able to displace below, not able. At some point we need to reverse. And as long as we get this bullish candle based on the CCT, we know that next candle is about to be bullish. Same thing here. That's what happened. And then we started pushing higher from here. Continuation here at this candle. This is weakness because we sweep the high but failed to displace and close above. That means we're going lower until this candle. This candle is bullish, and here we had a small closure below, but we did not see continuation. We flip bullish here based on CCT again. We have continuation to the upside, and then based on CCT here also we have continuation to the upside. So as long as we close for this day above this candle high, that means we could push higher. If we fail to close above and only wicks above and then maybe close somewhere in here or flip bearish, then we might go lower. It just tells you that there is some weakness and strength in the market at that specific level and specific time. The last secret, number 5, gold tends to respect manipulation long wicks, and they can be considered as a POI to enter from and expect them to be filled. Now, what does manipulation long wicks mean? So it's not just any wick, it's a manipulation wick, and that's what we're going to be covering on the next slide. So the manipulation wicks are wicks that sweeps the previous candle or any other major liquidity. Maybe there is another liquidity here that was also swept. So we have one, manipulation and a sweep. Second thing, we need to see a closure above the previous candle. You see here this bearish candle, we have the xauusd in this higher time frame. So higher time frame xauusd and lower time frame market shift. That's what we always focus on. So the moment we have this kind of pattern here, and not a lot of people are familiar with this, but this is a very strong level, and not the whole candle but the wick of the candle here. What you need to do is mark this zone here of the wick and then maybe use a Gann box or Fibonacci and use all those levels here: 0, 25%, 50%, 75%, and 100%. You will see that. Then you'll notice that a lot of the time, even if we're going up, price will tend to retrace to some of those levels, sometime to the 0%, 25%, and 50%, and also the 75%. And in some other times and rare times, it's going to sweep the low again and then push higher. Because sometimes we have a lot of liquidity below here, it needs to sweep. Sometimes no time for sweep, only 50% retracement going up. It also depends on what is happening here on the lower time frame. But I want you to focus on mostly 0 and 50%. Those are the two major correction levels to look for continuation from. Look for lower time frame confirmation from here or from the 0%. This can be used as a strategy itself. And believe me, at some point in my trading journey on gold, all I was looking for is this tab of POI and then looking for a lower time frame confirmation. That's it. And I do have an indicator that marks those zones for me. Maybe in some other time I'll release it to you, but it's very easy to identify. Let me show you some examples based on the specific concept. That is the manipulation wick. Now, if you go to gold on the 4-hour time frame, and this is the current time for gold, if we go and look for the pattern now in any time frame, feel free to look for this on any time frame. Make sure to also apply some experience here because we're not looking for anything blindly. And look for the pattern that I'm talking about. What is that pattern? It's when we have a wick, and it's usually a long wick that had some manipulation phase and then had a market structure and changes to the delivery phase. So what you can see is the sweep followed by a market structure shift, or CSD in this case. This is the pattern that I've talked about. If we go and mark the manipulation wick, which is this one here, and in some scenarios you want to look at also the quarters of this wick. So if I go and take the quarters just like this and drag it to the right. This is now can be used as a POI. Okay, and what you can see happening is price coming to the 0% retracement and then reacting of that level. And another time it comes very close to the 50%, reacted, 25% reacted, 0% reacted. It's all about the week. It's all about the week, right? Because this week here had done some manipulation as well as a market actually shift in one singular candle. The week is very important. So you see, you could have entered from any of those points. If you also look at another example, actually there is one that I'll just use for the sake of explaining. I'm not entering in all of those. You see this wick here? So what we had here is this manipulation as well as this market structure shift here. Now what we can do is use this wick as a POI. And what happened here is, I guess, one touch here, and that's it. And after that, we sweep and we go up. And after that, we again come to 50%, I mean 0%, 25%, and then it was disrespected eventually because we have a higher probability one here to get filled. So it's not any wick, it's wicks that are with a direction, with a bias, but most of the wicks can be used as really high probability ones. If we can look at also here, if we can also look here, we have some different examples. One is here, sweeping liquidity. So you see, we sweep this liquidity. Then this candle, what it does, it sweeps liquidity and then it breaks structures. What can we do with this one? Take our gam box from the high of the wick to the low. We can see that price even respect the 50% and not close below it. And then the next candle goes below and then it started going up. Right, so that's how we use the manipulation wicks. And again, this can be used in different time frames. Actually, one example that I can see is right here also on the 4-hour time frame. What we had here is this manipulation and then closing below the previous candle. That is a CSD, sweep here and then closing below. That validates this wick to be used as a POI. And what we can see is price coming to the 0% and reacting of that level. Now, I think if we take it more to the right, you can see that we get another retest to the 25%, sweeping this liquidity and then going lower. That's it for the video. Thank you for staying until the end of the video. Thank you for watching the whole video. I hope you learned something new. If you think this video is beneficial for other traders, make sure to share it. Leave a like and a comment with other video suggestion. This is Mulham Trading, and I will see you in the next video.